Good. Thank you. Thank you very much. Appreciate everybody watching in on this tutorial. Welcome to the Liz Bay Real Estate Group Multifamily and Commercial Real Estate Value Assessment. This is going to be one of the more critical tutorials that we're going to do. It's about establishing values for multifamily and commercial real estate. You'd be amazed at how many real estate investors, brokers, and people actually dealing in the arena of multifamily or who dabble in the area of multifamily and commercial have no real idea of what values are and how to come to those values for those properties. So this is what we're happy to welcome you to. Now remember, the biggest difference between single family and commercial real estate and multifamily is that single family real estate is based on a comparative market analysis, a CMA. This is a fundamental overview of what property values have sold for that are like your subject property and what those values must be. So it's pretty much apples to apples. If 3 properties sold that are most similar to mine in terms of square footage, style of property, then more than likely that is the worth of my property. But where commercial and multifamily tends to really differ significantly is that they're based on cash flow. Multifamily commercial real estate is based on how much money the property brings in, how much profit is really there. And that's where we get to a very key term, which is the net operating income, the NOI. This is the bottom line profit before taxes and debt service that a property generates. The NOI. This is a key term that's going to be used over and over again. So let's get a little bit more specific and dig into the NOI. The net operating income is actually the revenue that a property generates minus operating expenses. That'll give you the NOI. So again, it's the general revenue that a property generates minus the operating expenses that will give you whatever your bottom line is. That's the NOI, the net operating income. So let's give an example of how net operating income actually plays in. We have a 10-unit apartment building let's say in our example, we're getting $1,000 per month per unit. That's $10,000 per month. We have 10 units, $1,000 per month. Our gross income for that month is going to be $10,000. So we're taking out our expenses, management fees, legal fees, maintenance, repairs, vacancies. That leaves us with a net operating income of $7,300. Let's times that by 12, and that gives us obviously $87,600. So this is our profit. That's our bottom line net operating income. Now, here's another factor that we have to keep in mind as it relates to valuing multifamily and commercial real estate. Cap rates. Cap rates is a rate of return on your investment. Guess what? Each area has a cap rate. The more challenging an area, the higher the cap rate, which the cap rate is the return on your investment. So the more challenging the area, the more return you're expecting. And the lesser amount of challenges that are in the area, the more established, the more upscale an area, well, guess what? The cap rate is going to be lower. You have to do less. It's more predictable, the return you're going to be getting. So guess what? You get a lower return because it's a better bet. So what we want to do in every area is we want to know what those cap rates are always. So let's say, for example, property costs $1 million and we're making $80,000 per year in terms of our net operating income on that property. Well, we have a cap rate of 8%. So we're getting 8% return off of that $1 million. So the cap rate at that point is 8%. We have $1 million investment. Our net operating income is $80,000. Our cap rate at that point is 8%. Sounds easy enough. So let's find values. Let's find a property value. So let's just hypothetically say we have a net operating income of $87,600. Our cap rate is 8%. So that's going to be, in this equation, $87,600 net operating income over the cap rate, 8%. What do? Guess what? You divide. Once you have those two metrics in hand, you divide, you get a return of $1,095,000. So that's what this property is valued at based on this computation of value. Net operating income, $87,600. Over 8%, we have a value of $1,095,000. So once you have those two metrics, once you have those two factors, you're able to put together what the property, in fact, is actually valued. So let's say, what if you didn't have the cap rate and you needed to know the cap rate, but you had the selling price and the net operating income? So here we go again. We have the net operating income of $87,600 over the selling price of $1,095,000. Once again, you divide, and this way you're able to get the cap rate. Again, in this case, is 8%. You have an 8% cap rate. So by being able to invertedly use these formulations, you're able to come up with the cap rate, which can ultimately, with the NOI, give you the value. Or if you need the cap rate to get to the value, get the cap rate to get to question and come up with the value of the property, you can take the net operating income and go through the selling price and get the cap rate. So this allows you to check property values, allows you to see if there's a property being offered to you, if the numbers really make sense, and if the property fundamentally is worth it, or to be able to tell if you got a deal. Now remember, you can couple this with a comparative market analysis and use it as a comparison and still come up with the value and do a strong cross comparison, but you got to be able to measure those cash flows and those net operating incomes through the cap rate. So once again, study these formulas, practice them, and you'll be able to value commercial and multifamily real estate effectively.